Good morning, Chris. Welcome to the 1st September. How are you keeping?
Yeah, good morning. It is September already. And if anything, actually, the weather's got slightly worse, hasn't it, in recent weeks? So maybe we are truly moving closer towards autumn after a sort of a manic, super hot and super warm summer period. So yeah, welcome to September.
Yeah, that's an interesting point to start us off on, really, is actually climate change, because we've seen in Europe and China, sadly, the events in Pakistan at the moment with, a large part of the country underwater. I think it's the equivalent of the UK at the moment underwater there. This debate around climate change, how do you think that's going to change the investment world going forwards? Do you think what we've seen this year is going to put that extra sort of drive in governments to make positive change?
The answer simply is that it should do. And of course, here in the UK, I mean, there's, as you correctly say, Rob, lots of sadly very worrying conditions globally. But here in the UK, we've also had a lack of rain, a lack of water in many places, and all the restrictions that seem to have been building up over recent weeks. There are clearly many items to debate about this. The COP26 conference that we held here in Edinburgh, in Glasgow, last year, clearly that's something which should be impacting how governments are thinking. But the trouble is that I kind of feel that there's so much else to think about at the moment that it's an easy something to sort of put aside and ignore when people shouldn't, because the thing about climate change is it is a truly medium long-term game. You know, you may make some adjustments now in terms of trying to reduce carbon usage and related matters, but the impact, the positive impact from all of that takes many years to work through. And often governments today may not be the beneficiaries of it. It will be governments in the future. And therefore that makes it a difficult thing for people to justify doing. But they should, because clearly, patently, we can see it through some of the terrible images around the world, be it too much water or too little water related, it impacts us all. And certainly just thinking about the very narrow world of investments, whenever you have challenges with the supply of water, too much heat, lack of rain, whatever it might be, that is having an impact on our lives, business lives, what an economy is going to grow at, whether we can easily make money through our investments or not. It's massively material, very important, and if people ignore it, thinking that we should be worrying just about where inflation is or where what the growth level is or matters such as that, I think personally that they're wrong. You've got to play the long game at many levels, and climate change is one of those super long areas which we've all got to be focused on, not just today, but frankly for the next few decades.
Yeah, I think you're spot on, Chris. It's that holistic approach, and it's no different to what we do as financial advisors, that we don't try and pigeonhole ourselves into looking at one area of a client's sort of financial planning. It's the overall picture and what the sort of consequences might be in one part to another. So yeah, no, completely. Let's touch on markets a little bit more then, because you touched on economies, you touched on growth. Clearly, lots of volatility at the moment, and it's strange, isn't it? Even before COVID, I know as an investment committee, we've been talking about expect more volatility. We've been talking about that for several years, and we're seeing it now, aren't we? Clearly.
We are seeing it, and it's funny, isn't it? The thing about volatility is when you're not worrying about it is probably when it's going to happen. And when you're overly worrying about it or too concerned about matters, that's actually when you're perhaps looking at it too much. And what I find really interesting at the moment, and certainly as this year has progressed, clearly it's been a year of many changes, many challenges, many evolutions on many fronts. Many matters we've discussed in this podcast many times. But the trouble is that the world is tricky, but not impossible. And what I find interesting at the moment is that the volatility we've got, not just in equity markets, share markets, but also in bond markets as well. Also thinking about how governments are sometimes finding a lack of easy solutions or challenges. Central banks the same. There are many challenges around the world. And again, we could talk about geopolitics and sad issues in Ukraine, but also other matters around the world. We've touched on climate change already. So consequently, the world is tricky. But however, what I find interesting at the moment is that suddenly it seems to be very apparent over the last 4 or 5 weeks, people Commentators, observers have become very, very concerned about multiple issues: where inflation is going, lack of growth, is there going to be a recession, what is my house price going to do, issues with climate change, geopolitics. You can find a very large risk of potential issues. But here's the thing about the investment world is we always have problems and challenges. I'm afraid to say it's never an easy world out there. When you think it's simple and straightforward and there's no need for volatility or uncertainty, that's when it will come up and bite you where it hurts potentially. Fortunately, I think the fact that we've been talking about the risk of volatility, some of the reasons for thinking about, well, is it smart to be investing in that style? Should we be looking here? Should we be thinking about something else? Or debating some of these issues about geopolitics or or issues such as inflation or what central banks are thinking and matters like that. You've always got to be talking about it. We haven't been shy about making some observations, and we're going to have to continue doing that over the next few months and years, frankly. But that's how it should be. So I'm actually feeling, despite the fact there is a lot of doom and gloom and uncertainty out there, I'm actually feeling okay about the world. It's not easy, it never is, but it's also not impossible. And that's what always makes me optimistic. And so even though investment markets have been tricky, not just in shares, but in bonds as well, all across equity markets, I'm actually feeling that there are still things to be excited about, still reasons to be an investor. And frankly, certainly if you're thinking about, like you or I have to be, and practically everybody else probably listening, thinking about your pension, how you're going to look in terms of your personal finances over the next 10, 20, 30 years, you definitely have to be an investor. It's always essential to be one. Otherwise, what is the alternative? And if you don't have a plan and don't have an alternative, then I'm afraid not doing anything is not really an option.
Yeah, no, completely. And financial planning, investment planning, it's not a static approach, is it? It's always something that you've got to work at, tweak, change, and, take into account what's going on in the world. You mentioned there, Chris, about central banks. We've seen that the central banks have had a meeting in the US recently where the Fed chair made a bit of a speech, which was widely anticipated by the markets on the Friday morning. And to be honest, for me, it wasn't unexpected. He gave his hawkish opinion about they've got to tackle inflation. Interest rates are going to continue to come through it and increase. What's your take on it? Was you surprised, or was you thinking it was in line? Because the markets seem to be surprised because we've seen a bit of a sell-off since then.
We have done two things, really. First is I was very, very pleased that Jay Powell only spoke for 8 minutes. It was wonderful, the fact that it was such a short speech, and many leaders, central bankers, politicians could learn from that. A short speech can actually say everything that needs to be said, but thankfully in a succinct period. It wasn't a particular surprise. To be honest, we could talk about potential central bank moves in September as this month progresses. And my guess would be central banks in America, the Bank of England here, the European Central Bank as well, they will all raise interest rates in September. I need to tell people that, but I'm afraid I think it's going to happen. That's a reflection of the fact that there is still some inflation out there. And let's face it, we have been spoiled as investors or anybody borrowing money for the last 10, 12, 15 years. And that just got to neutralize up a little bit. Certainly anybody who remembers normal interest rates at 15, 20, 30 years ago will think, my goodness, interest rates are so low at the moment. It's no surprise that they're going up. So they're going to go up. Central bankers, though, I think are finally realizing two things. One is that they need to make sure that inflation is not going to be around for many years, because we saw the problems with that, certainly in the 1970s, and certainly at certain times in decades after that as well. It's not a smart thing to do. Reality is, though, is that I think we are at the peak of inflation concerns. And I know that feels very difficult to say when we've got what is our gas and electricity price going to do, particularly the gas side, which is a big concern at the moment, something which I'm sure we're all thinking about. But generally, when I look at the broader inflation matters, they're actually, I think, peaking at this moment in time. The world economy is slowing, there's no doubt about that, but it also, inflation is as well. And that will mean central bankers are finding it very difficult at the moment, and correctly are raising interest rates. This time next year, though, I think they'll be starting to say, actually, we don't need to raise interest rates anymore. What we need to do is now start thinking about what is the future sensible policy. Is it just holding interest rates, or maybe even considering, in some cases, pushing them down slightly? My guess is that they will hold interest rates for the next couple of years after the upcoming increases over the next 6 months, but we shall see. But at least hopefully they're thinking about it and realizing you can't have near zero interest rates for too long. It makes common sense to have some level of interest rates a bit more akin to what we're seeing at the moment and what we will get closer to over the next 6 months. So I wasn't surprised by anything, but as always, it came as a shock, as you say, Rob, to a few people, but such is life. And maybe because it's a summer, late August on a Friday, maybe it was just a bit of a concern. I think when we see what the Bank of England, the Federal Reserve and the ECB will say later this month, that will be a bit more interesting, a bit more properly insightful as to what their medium-term thing is. And my feeling is, in the UK, we will see interest rates a little bit higher, but not too much higher compared to today. And to be honest, if you're worried about interest rates, I would say I'd be worried if they were only going to be sticking around at about a 2% level. Because honestly, a proper economy, even an economy as old and mature as the UK, should have interest rates at a little bit higher than that. Otherwise, it feels a little bit unreal. And certainly anybody who's seen better times in previous decades when we had growth and control of inflation will know that a sensible rate of interest tends to be 3, 4, 5%. And my guess is we're moving naturally closer to that and more sensibly closer to that. But again, all eyes on the Bank of England in a couple of weeks' time.
Yeah, absolutely. It's funny, every client I have, I would say 50 plus, always reminds me about how interest rates in the 80s were. So you're absolutely right. I do feel that we are neutralizing and normalizing where interest rates should be. And I personally hope that happens with property as well, because I can see that certainly for first-time buyers and a lot of people, property prices have ran away with themselves. So if we do see a property correction, not that we've got a crystal ball and know what's going to happen, but if they do correct, again, that would be, in my eyes, just things becoming a bit more normal than actually a panic or a worry.
This is it, absolutely. And house prices are a very good feel for why things such as lower share prices or even higher bond yields are not necessarily a concern for anybody who's not looking just over the next few months. I agree. If you're looking to, oh my goodness, I need all of my money maxed out over the next few months, then yes, you've got to be cautious and probably saying, yes, I should hold only cash. But if you're looking to maybe you've got a pension profile which is maturing over the next 5, 10, 15, 20 years, honestly, you should be thinking, well, this is actually more of an opportunity than a threat. Now, that particularly refers to equities and bonds and other forms of generalized investments. As for houses, clearly, it's always nice to own your own house over time. That's a sensible thing to do, I think, for anybody. And certainly for younger people who perhaps don't have the opportunity yet to buy a house, actually, I believe the later 2020s will be more of an opportunity for them, because the combination of slightly higher wages over time, slightly lower house prices, that's a good combination for them. And frankly, again, I'd be worried if house prices only went up. It'll be nice for people like you and me, we own our house. But the trouble is that not everybody does. Young people certainly don't, or maybe they want to join the housing market. And it's much more sensible to see actually house prices realizing the fact that they can't always go up. My personal estimate would still be that house prices actually over the rest of the 2020s will do very little, which is different. It's not a disaster. It doesn't keep up with inflation and matters like that. But for younger people, that's a wonderful thing to hear. That is good news. Don't worry about slightly higher interest rates. Worry about the fact that if house prices only went up and up and up, that would be a bigger concern for you. But the combination of slightly higher wages, some inflation, but not too much inflation, and also lower house prices, that's nice for new home purchases over the next 5 years to be thinking about. So again, don't worry too much if prices are doing different things than you have seen over the last 5, 10, 15 years. If the world was always wonderful, it would be great at a certain level, but actually it's only the best for people who already are investors or are involved in an economy. For anybody still joining in a different country or in our own country, it's not as good, not as positive. So as always, an economy really progresses when the next generation are not only benefiting from it, but actually are actually making decisions and choices which actually are pushing the economy even further upwards in a positive fashion. That's what you really want to see. And so hearing if younger people are more excited about the world is always what I want to hear. And if they hear excited about joining the housing market or able to join the housing market, that's a good indication of that.
Great stuff. Thanks, Chris. Thanks for the roundup this month. Plenty going on in the world as we've touched on there. Let's see where we are in a month's time. I know we've got our investment committee tomorrow, so I'm sure we're going to have plenty to talk about there and digest. But yeah, thanks for your time today, Chris.
No problem. Pleasure.